When a new investor decides to invest in mutual funds, what's the first thing they do? It's simple. They head to Google and type the best mutual funds to invest in 2025. And they land on a website that ranks mutual funds based on past performance. Naturally, their eyes go straight to the 1, 3 and 5 year return percentages and they spot the one with the highest returns. Then comes the common thought. This fund has performed the best, so this must be the best to invest in. And with that logic, they hit the invest button. But this is one of the biggest blunder one can make in mutual fund investing, because the past returns you see, especially that CAGR percentage, can be highly misleading. So today, we will break down how to truly analyze a mutual fund's performance using real data, and by the end, you will know exactly what to check before making an investment decision. So the feast is ready, it's time to serve. Let's first understand CAGR in the simplest way possible. CAGR stands for Compounded Annual Growth Rate, which is just a fancy way of saying how much did my investment grow per year on average. Let's break it down with an example. Imagine you invested 1 lakh in this mutual fund in Jan 2015. After 10 years in Jan 2025, your investment grows to 6.9 lakh. Now if someone asks at what rate did your money grow per year, you can't just say 600% in 10 years because the growth wasn't linear. This is where CAGR comes in. It calculates a smooth and average growth rate over those 10 years. Let's say in this case, it comes out to 21% per year. This means if your investment had grown at a steady 21% every year, you would have reached the same 6.9 lakh. But here's the catch. Investments don't grow at a steady rate. Now let's do a small exercise. Take a look at this chart. It shows the 1, 3, 5, 8 and 10 year CAGR returns of two mutual funds. Now if you had to pick one, which one would it be? Take a second and think about it. Most people will go with the one that has outperformed across multiple time frames. And that's this fund right here. It looks like a solid choice, right? After all, it has beaten the other fund in almost every time period. But what if I told you this could be a big mistake? Because CAGR is just a point-to-point number. It only tells you the return from one specific date to another. What it doesn't show is the journey in between. Let me prove it. Here's the yearly returns of both funds from 2015 to 2025. Now look closely. Do you see the wild swings? 1 year, Quant small cap gives 91% and the next year it's down 23%. In some years, it skyrockets and in others, it crashes. But when you look at the final CAGR number, all this volatility gets compressed into a single percentage and completely hiding the risk you actually took. And this is exactly why relying only on CAGR to pick a fund can mislead you. So we saw how CAGR can be misleading. It's because it just takes the starting and ending points and ignores everything in between. But in reality, do we all invest on the same day and redeem on the exact same day? No. People invest at different times and that's why we need a better way to measure returns. This is where rolling returns comes into play. Instead of just calculating returns from Jan 2015 to Jan 2025 like CAGR does, rolling returns check multiple time frames like Jan 2015 to Jan 2016, then Jan 2016 to Jan 2017, then Jan 2017 to Jan 2018 and so on. This process continues for every possible start date within the given period. And once we have all these different returns, we take the average to understand how consistent the fund has been over time. Now let's make this even clearer by looking at the real data. I have taken the same two mutual funds as examples, Parag Flexi Cap Fund and Quant Small Cap Fund, and check their rolling returns. First, let's talk about 1 year rolling returns. Parikh had a minimum return of minus 18% and a maximum of 100% with a median return of 18.2%. On the other hand, Quant Small Cap had a minimum of minus 42% and a maximum of 223%, but its median return was just 9.1%. That means Quant Small Cap had a huge fluctuations, sometimes fantastic and sometimes disastrous. Now let's look at 3-year rolling returns. Parikh never went below 0.75%, while Quant Small Cap dropped to minus 17% at its worst. Parikh's median return was 18.7%, whereas Quant Small Cap had a higher median return of 27%. It sounds great, right? But wait. When we look at the 5-year rolling returns, Parikh maintained a minimum of 4.1%, while Quant Small Cap again had a negative returns going down to minus 9.7%. Now here's the interesting part. Let's talk about negative return frequency, which means how frequently the fund has delivered negative returns. Parikh had a negative returns only 10.5% of the time in 1 year rolling periods and 0%, which means there is no negative returns in 3-year or longer periods. Meanwhile, Quant small cap had a negative returns of 17.2% of the time in 1 year rolling periods and 16% in 3 years and even 6.7% in 5-year rolling periods. And this is crucial because imagine you invested at the wrong time and how often would you have faced losses. So lower the frequency of negative returns, the more stable the fund is. So what's the takeaway? Instead of just looking at which fund gave the highest returns, it's also important to check how volatile it was and how often it gave negative returns. In this case, Parikh seems to be more stable, even though Quant small cap had some years of very high returns. But let me make this very clear. This is not a fund recommendation. And finally, to wrap it up, CAGR gives a simplified view, but it hides volatility. That's why rolling returns are a better way to judge a fund's consistency. When we compared Parag Flexi Cap and Quant Small Cap Fund, we saw that Quant had higher peaks but also more negative periods, while Parag was more stable. The key takeaway is don't just chase high returns, always look for consistency. The idea is simple. When selecting a fund, always check rolling returns and see how often it went negative and pick the one with lower volatility. And that's all for this video. But wait, investing in mutual fund is great. But how much should you actually invest every month? Should it be 5,000, 10,000 or even more? Is there a simple way to calculate your ideal SIP amount? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.